Welcome back to the Neuro Finance Masterclass. We're on day 94 of our 365 Days to Financial Freedom series, and today we're bringing you a critical explainer. We're going to uncover the true fuel gauge of the market. We are talking about open interest, or OI, and how mastering this one specific metric is going to completely shift how you view market trends.
So yesterday, we took a really deep dive into the funding rate, right? We analyzed the sentiment of the leverage arena to see exactly who is paying whom. Exactly. But here's the reality check. Knowing who pays the fees, that's really only half the battle. If you want to truly rule the cycle, you absolutely must know how much real money is actively locked in those positions.
Okay, let's dive into this and map out today's framework. We'll start with the volume illusion, then define open interest. From there, we hit the four-quadrant rule, show you how to spot liquidity traps, and wrap it all up with the OI audit.
Part 1. The volume illusion and why the past doesn't predict the future.
We've got to address this massive amateur misconception right out of the gate. You scroll through any financial forum and you'll inevitably see someone pointing to a giant green candle screaming, "Look at the volume. High volume means a massive trend." But honestly, amateurs are strictly looking at the past.
Exactly. The architect, the disciplined, highly analytical player in the market, knows that volume only tells you what already happened. It is literally just a historical footprint. $1 billion in volume, that could just be high-frequency algorithms passing the exact same coins back and forth in a single minute. To see what's happening right now, and more importantly, what's going to happen next, we don't look at the past, we look at active capital. We look at open interest.
Which brings us to Part 2, defining open interest and measuring that active capital. Here is the strict definition for you. Open interest represents the total number of derivative contracts, so futures or options, that are currently active and open. These are contracts that haven't been settled yet, they haven't been manually closed, and they haven't been liquidated by the exchange.
Put simply, it's a real-time, completely undisputed measure of the total deployed capital that is currently sitting on the table with active risk.
And this brilliantly illustrates the difference. Think of trading volume as the total number of tickets sold at a stadium's entry gate, right? A scalper could buy and sell the exact same ticket 10 times right outside the venue, artificially pumping up the volume.
But open interest is the actual number of people currently inside the stadium, actively sitting in their seats watching the game. It is the real present participation.
Moving on to Part 3, the four-quadrant rule, the architect's matrix.
Now, this matrix is our core mental model for today's explainer. It's a mathematical necessity if you want to build high neurofitness and relentlessly filter out fake breakouts. We build it simply by mapping the direction of the price against the direction of open interest. Because both can only go up or down, we're left with exactly 4 possible market states. Let's walk through how these 4 states dictate the true underlying reality of the market.
First up, the most straightforward scenario. Price is rising and open interest is rising. This is a strong bull trend. What this means on a fundamental level is that new money is aggressively entering the futures market to buy. The upward breakout is real, and it's highly sustainable because it's backed by fresh capital fuel actively flowing right into the system.
But Quadrant 2, that is a massive warning sign. Price is rising, but open interest is actually falling. Yeah, this is a weak short squeeze or a fake out. The price is only going up because short sellers are in pain and they're panic closing their positions. Closing a short requires buying, which temporarily pushes the price up, but it rapidly drains open interest. Once those shorts are wiped out, the price is almost certainly going to collapse because there's a total lack of genuine organic buyers.
Moving to Quadrant 3, price is falling and open interest is rising.
Incredibly dangerous, this is a strong bear trend. Aggressive sellers are actively deploying fresh capital to open brand new short positions. They're confident, they're fueled up, and that downward pressure is completely sustainable. Literally, whatever you do, do not try to catch a falling knife here.
Finally, Quadrant 4. Price is falling and open interest is also falling. This indicates a long liquidation phase.
The market is basically cleaning house. It's forcing over-leveraged longs to puke out and close their positions. So the selling pressure isn't coming from new bears. It's driven entirely by trapped bulls. And that cascade will ultimately stall out once the open interest flattens and the excess leverage is fully purged from the system.
Section 4. Spotting liquidity traps. Don't get hunted. Understanding this matrix is deeply empowering. When you combine this open interest data with the funding rate we talked about yesterday, your trading system becomes almost bulletproof. It lets you expose engineered liquidity traps.
Let's move to and see how this builds in a real-world scenario. Step 1, the price suddenly breaks above a major resistance ceiling. Step 2, the retail crowd sees that big green candle, screams bull market, and blindly enters out of pure FOMO. But here comes step 3. You, the architect, check the fuel gauge. You notice that as the price broke out, open interest actually dropped and the funding rate remained totally neutral. You instantly realize it's quadrant 2. It's a fakeout. Step 4, whales use that very retail liquidity to trigger a reversal and hunt everyone's stop losses. But you didn't buy. You waited because you saw the truth in the data.
Part 5. The OI audit. Take command of your cycle.
Theory is absolutely useless without execution, guys. It's time to take command of your cycle and apply this intensely logical framework to the live market today. So here is your cognitive task. Step 1. Open a derivatives data platform, something like CoinGlass. Step 2. Load the aggregate open interest chart for an asset of your choice, like Bitcoin. Step 3. Locate the very last major price spike on that chart. And step 4. Physically write the 4-quadrant rule in your journal so it becomes muscle memory. It is time to stop looking at isolated candlesticks in a vacuum.
As you look at that chart right now, we want you to test your neural fitness on the real data and ask yourself this one question. During that last major price spike, did open interest rise, proving it was a true breakout? Or did it fall, exposing a trap?
The days of guessing are officially over. From now on, you don't just watch the price, you watch the active capital. Check the fuel gauge, identify the real accumulation using the 4-quadrant rule, and rule the cycle. Take this analytical framework, apply it to the charts today, and we'll see you next time.